All right, Alex, last time you said research is important before buying a stock, but honestly, what am I even looking for? Do I just Google, is this stock good?
Not quite. You want to look at stock metrics, numbers that tell you how a company's doing. Let's start with two big ones, the PE ratio and EPS.
PE ratio? EPS? Sounds like fishing jargon. Are we talking about pounds of fish or something?
Not quite, but close. Think of the PE ratio as the weight of the fish compared to the effort it took to catch it. It stands for price to earnings ratio. It tells you how much you're paying for every dollar the company earns.
Okay, so if the PE ratio is high, does that mean it's a heavy fish that's not worth the effort?
Exactly. A high PE ratio means the stock might be overvalued. Investors are paying a lot for not much earnings. A low PE ratio could mean it's undervalued, but you'll need to check why.
All right, so PE ratio is how much I'm paying for the catch. What about EPS?
EPS stands for earnings per share. It's like the quality of the fish. It tells you how much profit the company makes for each share you own. Higher EPS usually means a healthier company.
Got it. So PE ratio is the price tag and EPS is the quality. But how do I know what's a good number for these?
Good question. It depends on the industry. A tech company might have a higher PE ratio than a utility company. Always compare within the same sector.
Okay, I'll remember that. No comparing fish to birds, right?
Exactly. And don't rely on just one metric. Always look at the bigger picture.
So Alex, let's talk dividends. You said they're like the fruit trees of investing. How do I know if a company's dividends are worth it?
Great question. Two metrics to check: dividend yield and payout ratio. Dividend yield is like how much fruit you're getting from the tree each year compared to the cost of the tree.
Okay, so if the dividend yield is high, it means I'm getting more fruit for my money?
Exactly. But be careful. Too high of a yield could mean the company's struggling to keep up those payments. It's like a tree giving too much fruit and running out of nutrients.
Got it. So what's the payout ratio?
The payout ratio tells you what percentage of the company's profits are going toward dividends. A lower ratio is healthier because the company is saving money to grow. Too high, and they might be stretching themselves thin.
All right, so check the yield and the ratio. What's a good range for these?
Dividend yield around 2 to 6% is often sustainable. Payout ratio below 50% is usually safe, but it depends on the industry.
Okay, so I need a tree that gives steady fruit but doesn't overwork itself. Got it. All right, Alex, let's get back to the fish. What if I want to know if this lake has more fish next year than it does now? Is there a stock metric for that?
Yep. That's where revenue and earnings growth come in. Revenue is the total amount of money the company makes, like all the fish in the lake. Earnings growth shows how much of that is turning into profit over time.
Okay, so if revenue is up, that means there are more fish in the lake. And earnings growth tells me if the fish are getting bigger?
Exactly. A company with steady growth in both revenue and earnings is like a healthy, thriving lake. It's a great sign.
But what if revenue grows but earnings don't? Yeah, what does that mean?
It could mean the company's spending too much to grow, so profits aren't keeping up. It's like overfishing the lake. Lots of catches now, but not sustainable long term.
So I need to watch both to make sure the growth is balanced. Got it.
Exactly. Consistent growth in both areas is key to finding strong investments.
All right, Alex, what about the warning signs? How do I spot a bad stock before I get hooked?
Good question. Look out for declining revenue, inconsistent earnings, or high debt levels. It's like fishing in a polluted lake. Nothing good is coming out of it.
Okay, but how do I check if a company has high debt?
Check the debt to equity ratio. It tells you how much debt the company has compared to its assets. A high ratio is a red flag.
All right, so no overfished lakes and no debt-filled ponds. Anything else?
Watch out for companies that overpromise or have a history of missing earnings expectations. If the water looks too calm, there's probably a storm coming.
Got it. So I'm looking for clear waters, steady catches, and no scary undercurrents. Makes sense.
Exactly. A little research up front can save you a lot of trouble later.
All Alright, folks, what's the first stock metric you look at when deciding to invest? Drop it in the comments. I'm curious to know.
And if you missed our chat about managing risk, go back and watch it. It ties perfectly into today's discussion.
Next time, we're diving into understanding market trends. Don't miss it. See you there.